When we talk about algorithmic trading, it's often painted in black and white. You'll hear it described as either this incredible force for market efficiency or as a source of wild, unpredictable chaos. But the truth, as it often is much more nuanced. The real impact of these algorithms isn't so simple. It's a story of context, where the very same code can be a stabilizing force one moment and a destabilizing one the next.
And that brings us to the central question we're going to explore. Are these incredibly complex, high-speed systems a force for good in the market, or are they a hidden catalyst for chaos? The fascinating thing is, the answer is yes to both. Understanding that duality, when they help and when they hurt, is absolutely key to understanding modern financial markets.
So let's start with the upside. Let's look at the algorithm in its natural habitat, which is a normal, everyday market. Under these calm conditions, the evidence is pretty overwhelming. Algorithmic trading plays a very positive, very significant role. This is the side of the algorithm that helps keep markets healthy and functional for everyone. It really helps to think about this in terms of two different states. In normal market conditions, everything is working as it should. Algorithms are enhancing liquidity, they're reducing volatility, and they're making sure prices are fair and accurate. But when the market is under stress, that picture flips completely. They can withdraw that same liquidity and actually amplify volatility, leading to dangerous chain reactions. This duality is really the whole story.
And we can actually put a number on that stabilizing effect. Research has found a pretty direct link here. For every unit increase in algorithmic trading, the standard deviation of intraday returns, which is just a way to measure volatility, goes down by about 0.817 basis points. Now, that might sound like a tiny number, but when you scale it up across the massive volumes traded every single day, it represents a very significant calming effect on the market.
So how exactly do they do that? Well, it really comes down to three main things. First, they operate on pure data and logic, which strips out a lot of the irrational, emotional trading that we humans are prone to. Second, they can process new information almost instantly, which means prices reflect their true value much, much faster. And third, their constant buying and selling tightens the bid-ask spread. That's the gap between buy and sell prices, making trading cheaper and more efficient for all of us.
A huge piece of this puzzle is something called liquidity provision. It sounds technical, but the idea is simple. It's just the act of making it easy for anyone to buy or sell something when they want to. Algorithmic traders are fantastic at this in calm markets because they're always there, placing both buy orders and sell orders, creating this deep, reliable pool so there's always someone to trade with.
But all of this good work has a breaking point. There's a critical moment, an inflection point, when the market's mood shifts from calm to stressed. And it's at that precise moment that the helpful, stabilizing algorithm shows its other, far more dangerous side.
This quote really captures the heart of the paradox we're talking about. The very same automated systems that act as the bedrock of the market on a quiet day can become the primary engine of instability when a crisis suddenly hits. The logic that makes them so efficient is the same logic that makes them so dangerous under pressure.
So what causes this sudden shift? It all boils down to one simple factor: risk. As soon as volatility starts to spike and uncertainty creeps in, the game changes. An algorithm that was designed to provide liquidity is now facing the huge risk of making a bad trade. Its core programming tells it to protect capital above all else, and the safest, fastest way to do that is to simply pull back, to cancel its orders, and vanish from the market. And this happens at the exact moment that liquidity is needed the most.
Now, there is no better real-world example of this dynamic than the infamous flash crash of 2010. This event was a brutal lesson in how a network of interconnected algorithms can take what should be a manageable problem and turn it into a full-blown market catastrophe in a matter of minutes. And just to give you a sense of the scale of what happened, in the span of only 36 minutes, roughly $1 trillion in market value just evaporated. Now, most of that value came back pretty quickly, but the speed and the depth of the fall exposed a terrifying new kind of fragility in our markets, one driven entirely by machines. And that kind of event impacts everything, from the biggest investment funds all the way down to individual retirement accounts. The chain of events that day was lightning fast. It all started with one large, automated sell order in the E-mini futures market. In response, high-frequency trading algorithms began frantically trading these contracts back and forth among themselves, almost like a game of hot potato. This created a ton of trading volume, but it didn't actually absorb the selling pressure, so the futures market price collapsed. That collapse then triggered other algorithms in the stock market to start selling aggressively. And then came the final blow, a wave of automated stop-loss orders kicked in, creating a catastrophic, self-reinforcing spiral of selling.
You can see how this creates a truly dangerous feedback loop. A big sell order causes an initial price drop. Other automated systems see that drop and immediately start their own defensive selling to cut their losses. But of course, this new wave of selling just pushes prices down even further, which in turn triggers even more automated selling. Each step amplifies the one before it, and that's how a single large order can morph into a market-wide crash.
And when you dig into the data, it becomes clear that not all traders were contributing to the problem equally. Research shows that a unit increase in high-frequency trading, or HFTs, actually increased volatility by a shocking 279 basis points during the crisis. Other buy-side algorithms also added to the problem. What's really interesting is that non-algorithmic, human traders actually had a slight calming effect during that time.
So, besides that feedback spiral, there are a few other powerful forces at work. The first is that algorithmic liquidity is often described as brittle. It looks solid and deep, but under the slightest pressure, it shatters. Then there's algorithmic herding. This is when thousands of different systems, all using similar strategies, react in the exact same way at the exact same time. And finally, you have network contagion, where a shock in one market, like futures, can spread to another, like stocks, almost instantly.
As you can imagine, the flash crash was a huge wake-up call. It was a clear signal to everyone that the fundamental structure of the market had changed, and the old rulebook just wasn't going to cut it anymore. This led to a major regulatory push to try and get a handle on this new, much more fragile system.
Since then, regulators have introduced several new tools designed to act as guardrails. The most well-known are market-wide circuit breakers, which can literally halt all trading to give everyone a chance to breathe and break a panic spiral. Other rules include things like minimum resting times for orders, designed to cut down on manipulative strategies, and much stricter requirements for risk controls and reporting, forcing firms to be more transparent about what their algorithms are actually doing.
But of course, technology never stands still. Just as we're starting to get a grip on the risks from the first generation of algorithms, the next evolution is already upon us: artificial intelligence and machine learning. This brings a whole new layer of complexity and potential risk to the table, from AI models whose decision-making is a complete black box, to the danger that different AI systems might all learn the same strategies, making that herding behavior we talked about even worse.
So, in the end, we're left with this very delicate balancing act. On one hand, algorithms bring incredible efficiency and stability to our markets on most days. On the other, they introduce this deep fragility that can be exposed in times of stress. As we head deeper into an era that will be dominated by AI, the fundamental challenge is the same. Can we design a system that keeps all the benefits of that efficiency without creating a market that's always just one bad day away from chaos? That's the critical question we all have to grapple with moving forward.